All right. Good evening, everybody. Steve Goodey here. How are you doing? Great to have you on board. Today's webinar is New Tips and Tricks for Retaining Finance 2025. So we've got my very good friend on board tonight to run through some questions and answers. His name is Mr. David Windler, and he's an award-winning advisor, which is hard to do because he seems to win these awards every blooming year. And, he's merciless about rubbing it in. I can see him, but he's giggling, so it's all right. He's been a mortgage advisor for 15 plus years and runs a very, very big crew nationwide these days and done over $1 billion worth of work written. But more importantly, the reason I really like talking to Dave and the reason I like having him on these webinars is he's actually just a great bloke, and he's very, very good at explaining slightly complicated things to people like me. So I'm going to biff him up on the screen now, add onto the stage. Hey, Dave, how you doing?
Steve, good evening. Hey, everyone. How you doing? All right?
Yeah, excellent. How do I do it with two people? Hold on. Oh, I'm going to muck it up now. I'm going to get told off. Oh, I'm going to get told off in a minute. You wait. I'll leave it there. Anyway.
Good. Yeah, really good. Really busy. Obviously, it's been an interesting day today with some certain announcements, and we'll touch on that pretty soon.
We'll definitely get into that. I think that'll be really interesting. But firstly, we've done a slight introduction, but I think we have to mention the true VIP of tonight's webinar, which is Robert, who's missing Married at First Sight for these. No, credit was due. I myself have never watched a Married at First Sight or a Kardashian ever in my life. I just don't do TV, but I respect the struggle when I see one. You know what I mean, Dave? You know?
Absolutely.
You got to imagine there was discussions, there was a fight in that household, and I won. Honestly, I'm just gonna take the win on that one.
Love that. That is brilliant.
This is why people don't put messages in the. Anyway, if you have a question, not about tonight's viewing, but like about mortgages and interest, like I get so many of these questions, Dave, you would not believe, and I can't answer them. I can give my opinion, but I'm not a financial advisor or mortgage advisor like you are. And so when somebody asks me, should I fix or not fix my mortgage? What should I do with this? What should I do with that? It is actually a much larger question than it looks. And what it really means is in the position that I'm in. And so they don't want to know my position and I don't know their position. So I can't say, right? And so I always pass them on to a mortgage advisor, always you and your guys nationwide, because as you know, I work with Carl Mann quite closely here in Wellington. And every time I ring him up, I get a nugget, a piece of gold. I get something because he's spoken to that bank's credit team or BDM that day for someone else because they're dealing with this stuff absolutely every day.
Yeah. And I think, when it comes to sort of that whole, what do I do with my rates question, it's so personalized, so individual. And I would imagine that, when you make that phone call to Carl, first thing he's going to ask, is anything changed since the last time I spoke to you, Stu? What's the latest and greatest? And then pulling that through and matching it to what we know at the coalface on a day-by-day basis, and then starting to have some conversations around decisions that are tailored towards the individual. So ultimately, folks wanting to tune in around the rate question, and we'll move through to this shortly. We'll give some general comment around it, but ultimately they've got to speak to their advisor in the end. If you really want to get, and it does frustrate me a little bit in some of the Facebook groups that I'm a part of, where people just come in, these are the rates I've been given, which one should I choose? Well, you're not going to get an answer from a Facebook group. No, because we day every day.
Let's go back to that conversation. But firstly, you guys are running a pretty major outfit now.
Yeah, I guess the purpose of this slide is to suggest it's not just about me, right? No. We we kicked off some 15 years ago, and have bit by bit organically grown over time, and got a wonderful team of advisors who operate in all sorts of parts of New Zealand, and have grown the offering into those other advice services that the insurance, both the risk, personal insurance side of it, and then fire and general. And then recently we've gone into the Kiwi side, which probably for me is actually really exciting because we just come across so many instances where people have got quite reasonable sums of KiwiSaver that in funds that are just not performing. The option is there. It's very easy to transfer. So, yeah, I guess now it's more of a group of companies and a more rounded advice that we're able to give people, which is really really pleased.
I did hear that stat this week saying that there are some people in KiwiSaver after what it's been around 15 years now, who have close to $3 million in their personal KiwiSaver.
Yeah.
Oof, blimmin' heck, doing well.
Yeah.
And the other question I was going to ask, and I don't know if I'm cornering you or not, but do mortgage advisors get a commission for refixing a loan?
Yeah, they do. It happens in two different ways. So, just in terms of that remuneration piece, I'd say that there's two groups of banks, right? One that pays a larger upfront, say averaging out at say 0.85% of the loan amount, and there's another group that provide a lower upfront, say 0.55, but then they pay what we call trail. Okay, so they pay a smaller percentage of the commission on a monthly basis. It might be 20, 30 bucks, something like that, very small, but it's there. Those banks look at that as a fee for service. All right, absolutely obliged for us to service that client on behalf of the bank. But we're obliged to service all of our clients. That's how I look at it. Those banks that pay the higher up front for a refix, they'll give us 150 bucks. And they've paid us 150 bucks for as long as I can remember. Probably these days doesn't even cover the cost of actually the time it might take to do everything that we will do with that. But a good mortgage advisor should service their clients on an ongoing basis. They really should. And I think these days, one of the majors is that I think that our clients have become a lot more aware when they're at the end of their cashback requirements, that that 3-year mark hits. And clients are talking to us about, I've done my 3 years, I've got my cash back, I want another cash back, thanks. So is what 100%. So, and certainly with regards to our friends at the Commerce Commission, right? Our obligation absolutely is to the client. And if it's in the client's best interest to move from bank A to bank B, we're in there like Flint. Banks don't necessarily like it because they call it churn. But number one rule of thumb is the client comes first. 100%.
Yeah, and okay, 3 things there. The first reason I brought up that con is because a lot of customers don't contact their broker because they don't know that you get paid to do that service of refixing and serving the customer. And so why wouldn't you ask your advisor for some advice and get them up to date with where you are when you are refixing?
Absolutely.
Absolutely. The next thing is, I did hear a story just today of a very large landlord in Wellington, and one of the main banks, 3 initials, said that he would, instead of being residential, he would now become a commercial customer because he was at the max level of lending that that bank would give any one client, which was $25 million of lending. And they said, we're going to push you to commercial, so your interest rate's going to go up slightly. It's going to be a 15-year loan across the board, which is just going to kill his cash flow. And so he refinanced to another bank for the entire $25 million in a day because the other bank went, we will take that. Yes, lovely. Yum, 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 yum. Unbelievable. You imagine the cashback for that will be 1% per date or something?
They tend to have a wee little cap on it, though, Steve. Normally can cap out at 10 grand. If you want to go beyond that, you've got to do some pretty good negotiations. But that whole thing about going from retail to commercial is certainly something we try and avoid. And any portfolio investors out there, hopefully you've got a spread of providers amongst your securities, because surefire you want to stay in retail. The moment you go into commercial, rates go up. Quite often they have covenants that you've got to send in your financial accounts every year. It just starts to get a little bit messy. So we certainly try and stay under the radar.
Yeah. And I mean, if you're turning a book of business over in 3 years' time too, it's a pretty good negotiation tool to stay with the same bank if there's something you want from them, to not move, because within 3 years, I doubt if that bank's broken even on that client.
Yes, and a few of them will offer retention cash. So at a lower level than going and getting up to 1% somewhere else, but they will. So if there's a convenience factor, 100%. I don't think anytime there's some free money on offer, we want to go chase it, right?
Yeah, absolutely. All right. So remember, guys, in the other side, that side. Yes. So on the far side of your screen there, you've got a question section, and you can chuck in any question you want me to pitch to Dave at all. Make them smart, because then I'll claim they're my questions and it'll make me look good. Okay. All right. So let's this is really the big question at the moment. Like, I spoke last week on the webinar that about when interest rates are actually going up, people fix immediately because they don't want things to get worse. When interest rates start to come down, everybody's an expert suddenly around the fireplace. Everybody's like, I'll go lower, hold. It's like Mel Gibson in the Scottish movie, hold, like everybody's waiting and waiting. And they're trying to hit that bottom point right at the very bottom where they have this magic point. I very famously to me in my household, fixed with the Blue Bank last week, and I took 4.99% over $1.7 million worth of debt with BNZ and ASB, a bit of a mixture of mortgages. I'd been floating on those for quite some time, and I did the math, and the math was telling me how many months at 4.99 I had till I broke even if I waited for it to go longer. And I also looked at my portfolio. I knew that I had other stuff coming out before Christmas. So if it goes lower, I can actually still take advantage of that.
The rest of the stuff you had going on, right? Yeah.
Yeah. And so the 4.99 over the 6.85 I was on before is actually going to save me $2,000 a month.
Did you get that for 2 or 3?
2.
Yeah. So two's where on the 2-year rate, everyone's at 4.99. Go back 2 weeks ago, you could get it from a couple of places for 3. Westpac went there. When the OCR announcement came out, that was their carded special. As soon as the OCR came out, they took it off the table, went out to sort of 5.29, and then they were doing it under the card for about 4 or 5 days, and now that's gone as well on the 3-year money. So, but everyone's sitting in at that 4.99, and I think if we go to the rate card on the next slide for a moment, Steve, that you can see that these are sort of the best rates that we've had over the last few days. And people on the call may well have a 0.05 better here or there, but this is generally where the market is sitting at the moment. Quite a lot of these rates actually coming out of TSB.
Yep. That's where that 35 mil lending went.
Yeah. But yeah, they would have climbed all over that, and their terms would have been really good. That 559 sits at Kiwi Bank. And I think with rate conversations that I'm having at the moment, there's 2 trains of thought for me in my mind. Factoring in all the client circumstances, either people are looking at the 6-month rate and going one more time, or they're hopping straight on that 2-year.
Yeah, agreed. That's the only consideration people are taking at the moment. And honestly, I feel it's a little dangerous because I've said this on the Facebook page in the past, recently, 7.25 is 25-year average. All of these rates are a long way underneath that. In some stages, people are doing this for cash flow because they just don't have it. I know that I was bitching and moaning earlier this week. Some of my insurances went up 47%. But I just did a very interesting Wings Wednesday with my builder, Aaron, and he was saying that in projects in Wellington at the moment, they're going around the 6 main insurers in New Zealand, and they can't find anybody that will underwrite Wellington right now at all.
Insurance is a real problem.
It is.
I think for anyone out there who's looking at, re-entering or adding to the market, or, buying their first rental, one of the things you've got to get onto early is the insurability of whatever it is you're looking at, and do not go unconditional without knowing that you can get cover.
Or make your contract conditional on being able to get cover, actually putting it in, and, to going back to post-earthquake styles and actually putting it in as a condition, because, it's getting pretty scary out there because there's only 4 or 5 insurers in the country, and they're all using the same reinsurers. It's the reinsurer who's getting sticky on this stuff and making it hard work. But what I was saying was, like, with these carded rates, 5 years at anything under 5%, you've really got to start taking a serious look at it. And one of the things I've said in the past is people come back and push back at me and they go, well, look, I don't want the 5-year rate. I don't know if I'm going to own the property in 5 years' time. And that's fine, but quite often you will still retain the debt, but sell the property, because you can take that debt and secure it against something else and sell the actual physical assets, or swap it for a new physical asset, keep the lending and not break it. it's
Yeah,
possible.
if you can set the deal up so you've got a contemporaneous settlement, both sale and purchase happens on the same date, then you just transport the loan from one property to the other. If it's a higher value property, there's a top up. But yeah, absolutely feasible. But and I think that for the most part now, we're certainly looking at splitting larger loan sizes so people can take different rate options, particularly over owner occupied lending. And with investor lending, it's just looking at the real cash flow of the property. Now, if you take 499 and your rent covers your interest costs and your other costs of ownership, is that a good thing? Yeah. Because you probably might be hopping off a 689 where you've been underwater and topping it up for a while. So, I mean,
Absolutely, that's
and so it becomes an attractive option and becomes a safe option and a certain option. And we're doing quite a bit of it. We're doing quite a bit of it. But then there's another school of thought where people are going, well, actually, I think they will come down, and therefore I'm going to go one more time and take the 6 months. So we learned.
that's the floating at the moment. You really wouldn't.
No, I wouldn't stay on floating for too long.
No.
And
the other thing you were saying about keeping the debt, selling the asset but keeping the debt, it being a contemporaneous settlement, it doesn't have to be. What you can do is sell the asset before you've bought another property, and you give the bank back their money under a term deposit without breaking the mortgage, and you just pay a little bit extra. It's like 1.5%, 2% difference between the income from the term deposit and the outgoings from the mortgage,
Yeah, particularly the majors, they'll do what's called a set-off and charge against the term deposit. They'll take the term deposit as a security, and then you settle on the property. They'll transfer that security through to the mortgage on the property. Yep,
True. And often you can do that. Once you've got 5 or 6 or 7 plus properties, you can actually do that with offsets and redraw facilities as well, which is, once again, it's complicated, but it's something that brokers can do and explain and help you out with. So let's talk about this. This is getting interesting. So let me tell you a wee story. I've met Adrian Orr a couple of times. Personally, don't mind him. He's a farm forestry boy from Taupo at heart. He really is. He's a bit of a bogan. He'll admit that. He 5:00 tonight before our webinar, I went out for our standard Wednesday couple of beers down the boozer with the usual suspects. Aaron, my builder, and a couple of mates. And Wings Wednesday was good. And Adrian was there, having a couple of beers with him at a couple of tables away from us. I was super tempted to go and say hey. I thought it would go down like a cup of cold sick, so I did not. Shorts, t-shirt, jandals. He looked super relaxed. I would love in the next couple of months to figure out what's actually happened here, what's gone on, because he was signed on by, I think it was Chris Luxton originally, but Jacinda re-signed him for the second 5 years. And of course, the Reserve Bank's supposed to be totally independent of government, but it's just not. Obviously his boss, if you want to call it that, is Nicola Willis, the finance minister, who's Central Wellington, lives here in Central Wellington. And you just got to ponder whether he jumped or was pushed. Let's be fair. Let's not beat around the bush here. What are your thoughts, Dave?
Oh, look, it's poor form to speak ill of the recently departed, right? I
had a drink from Matt Gilligan earlier.
Yeah.
He's selling. He is.
Look, it reminds you of those situations where, in club football, when the chairman of the board comes out or the owner of the club comes out and goes, they'll be really in behind the manager, and 2 weeks later they're gone. And I think that for me, and look, this is just a personal opinion, but if you're going for your own reasons, right, and why on earth wouldn't you say that? There's been no commentary. He's just basically gone, disappeared off into the sunset. He's not going to work tomorrow because he had annual leave accrued. It's like a dump and run. Yeah. And that to me is a sign of someone who's, to be frank, pissed off about something.
It was
suggested. or it's been suggested he's got to go and go pretty quick. If I was leaving a role and I had good reason for leaving the role, I would say so. I would front up. I'm going. I've got inflation back to 2.2%. It's in range. I feel I'm reading the good play. Whatever you think about what he's done, you'd be fronting up, going, I think I leave it in a place that I can hand it over. I've done my time. I'm gone. And you front up.
And the thing is, what do we get now? What happens next, right? And this is the question that I've got from Elton, based on last week in my webinar. I did some predictions, and I said that the Reserve Bank governor has said that they want to bring the OCR down to 3% flat, which is another 0.75 reduction. And I pointed at a 0.5, 0.25, 0.25 cut. And so Elton's asked me the question, has this changed anything? And I honestly don't think it has, because the economy is still the economy. Inflation's still at 2.2%, down from 7.3 or something. And despite the $750,000 a year salary, this wasn't all on Adrian Orr. He was
They're a committee.
It's a committee. It's absolutely a committee. And Tony Alexander wrote a piece this afternoon for the papers saying exactly that, and saying that the direction that the ship's been pointed in will not change because of the adjustment of the head guy being exited or chopped off or tall poppied or whatever you want to call it. I personally think that he, I think like most people, he's not a bad geezer. No disrespect. He just acted too slow. We should have been in front of this. It's a big, noisy, nasty ship to move. But then I also remember back 6.5 years ago when he first came in, and the government at the time, Auntie Jacinda, basically said, well, what about inflation? And he pointed to his charter and said, well, look, my charter doesn't include keeping inflation under control. And so I'm not doing that. And the government, who's not allowed to tell the Reserve Bank what to do, put it in his charter within 2 months and changed his entire job description. Said, well, there you go. Now it is your problem. And he fixed it. He fixed inflation by killing the economy. I mean, come on. One thing at a time, cupcake,
But obviously on reflection, too slow to react, right? We'll slowly wait. In due deference, though, one of our major issues is quite a lot of our economic data comes out in quarterly.
Yeah.
And so you're quite often working off old data that's old.
Yeah.
Right. So we printed too much money. 71 billion.
Yeah, 83% increase in debt the country's got.
And inflation went to a 32-year high, 7.2% at its highest. So, I think if you're going to look at the end of year report and hand some marks out, it ain't going to be an A.
Yeah.
Right?
Yeah.
Now it depends on what we're going to get next. So Christian Hawkesby now steps in immediately. There's a poison chalice, imagine getting that phone call today. Goes through the end of March in a acting role. And then I think from there, it's a 6-month temporary appointment. Now, if Hawkesby's in there till the end of the month, and then there's a 6 months appointment thereafter, there's no way that person is going to be anyone else but Christian Hawkesby. All right?
Yeah. It's good how you go thing, isn't it?
Well, absolutely. So we're going to be I think we'll be in a holding pattern, because no one in their right mind comes into a job and turns it upside down immediately. They take a look at the lie of the land, particularly if they've been responsible for setting the lie of the land in the first place.
Yeah.
So I think we're not going to see a heck of a lot of change for the moment, and it's going to be after that 6 months and whoever gets appointed then that we may potentially see some change.
Yeah, I mean, the discussion over chicken wings today, super important high-level discussions, was if it comes out in the press that it was something naughty happened or there was a health issue, then it's all hands on deck, right? But if he was actually pushed by Nicola Willis and the government change, it might be a change because they want the OCR to be relaxed faster or slower. And you don't know, and you're probably not going to know, honestly. Yeah, it's hard. I mean, we've got a little bit of feedback here from the man himself. Adrian says, "Good luck, New Zealand. I'm off on holiday now. Stuff the country." I see you guys. You think you're funny. Honestly,
Love
you
it.
don't get away with much around here. Come on. Yes.
I was kind of pleased he hopped on in his spare time.
Well, he's got a lot of spare time now, obviously. He was one beer and out tonight, though, to be fair. So, maybe he's got another posting or whatever. I do have a question here for you, though, from Tony. Have you had experience extracting usable equity from rural property portfolio with a plan to go to residential?
Yeah, rules can be quite tough for the average mortgage broker because obviously it's a very specialized field, and particularly if it's an operating farm. What I tend to do with my rural clients is do it in collaboration with a really high quality rural manager. So I'll ride shotgun on the whole deal and make sure that we're collaborating with a rural manager, because most mortgage brokers do not know how to put together a rural deal. Okay, so Tony, if you want a bit of a steer on that, feel free to reach out. I'll give you a hand.
Yeah, absolutely. Also, another quick question here. Can you tell us who was doing 4.9 for 1 year?
TSB.
TSB. Anybody matching that at the moment, or?
Not that I know of. That was the best 1 year I could get my hands on in the last couple of days. The rest of them are just sitting just above it, like 5.12 or something ridiculous like that. There's some very strange rate offerings, 5.12, 5.14, just above.
I know that I know you work with the banks all the time, right? But I'm allowed to say this. I hope everybody online tonight it's our webinar. Come on, man. I hope everybody out there appreciates that banks are not your friend. And I know I'm saying it because I know you can't.
I can't. They're not our friend either.
Sometimes banks put out rates that are predatory. And so if interest rates are going up, they might put out a cheap rate. If interest rates are going down, they might put out a cheap rate because they believe that rates will be below that later on. And they want to lock you into that cheaper rate. Have a think about the curve of interest rates, whether they're going up or whether they're going down in a graph from 6 months, 18, 24, 30, all the way through to 5 or 6 years or whatever you can get. Have a look at that graph. That's a rolling graph that will come through, and that's the prediction of where the banks and that particular bank economist believes interest rates will be at that time. And they are there to take money off you and make profit for their shareholders. Yeah.
They're not charity, right?
Well, not at all. And, that's the thing. When they bring in, banks love to bring in a rate like 4.99 because it's nearly 5, but it doesn't look like 5. And everybody jumps on it.
What we call it Woolworths price, right? So go to the supermarket, mate. Nothing's $5. It's 40. Might get it for $4.99. But I think with the banks, it's like we as investors, we've just got to manage our situation and control it as much as we can, bearing in mind that we have freedom of choice for the most part as to which one of the banks we wish to deal with.
Absolutely. And I think that freedom of choice is, wise thing to take into account when they're giving you cash backs and stuff. I mean, if you can pick up $5,000 or $6,000 cash back on a couple of $1 million worth of lending every 3 years and back that in as in, don't go to Hawaii with it, don't buy hamburgers, knock it off equity owed on the mortgage. It'd be interesting to look at a graph over a period of time, you know what I mean?
But that's up. But price isn't the only factor, right? When we're choosing a provider, I think the number one factor is approvability. You don't get to choose your interest rate until you've got the loan approved, right? So step number one has got to be approvability, and there's still quite marked differences between the banks as to if they will approve you under your circumstances, and if they do, how much. Now, if you take, this is random sort of example, let's say Bank A approves you for $650,000, right? You go out and buy a $650,000 property, but Bank B that you don't know about because you haven't looked at them because you've gone to Bank A because they're your bank, Bank B would have given you 750,000. And let's say those same properties increase in value year on year 5%.
Yep.
What does the end position look like in 20 years' time?
True. And there's other considerations too. And I don't want to put the shits up everybody online tonight, but I reckon with interest rates going down so severely that the economy's in a really, really bad position. And I agree with some of the comments that I'm reading in the side there that it's originally a Grant Robinson issue, right? But if the economy's in a really, really bad position, this is the point where some banks start actually really tightening up to a surprising level and they start doing some weird shit. One of the things that I saw at this point at the end of the last bust was banks would sometimes, don't quote me on this universally, but sometimes they would close down redraw facilities overnight without giving notice. They just end it. They just go, no, no more. And if you're living off that or from it, it can be quite frightening.
It happened through GFC. I mean, I'm one of the people who was a broker, and through GFC, and that's sort of the benefit of some longevity in industry. You're kind of seen it all before, right?
Yeah.
And GFC was different because it was like owning a retail shop, but you had no product on the shelves.
Yeah. Could do much, right?
You couldn't do much. And this is, I think, a little bit different in that economically it's been touted as being worse than GFC, but I think we've still got product on the shelves. Okay. And if I look at where banks' appetites are and where their behaviors are, I would put them into being that they're pretty reasonable. They're pretty reasonable, because what's happened, as you were just saying a little earlier, is that these drop-in rates have flowed through to drops in the servicing rate. So the rate at which the banks test your capacity to borrow has now dropped down to sort of 7.25
from 9.
Rates up. Yeah. So everybody on the call can borrow more money comparatively than they could 12 months ago.
Whether they realize or not.
Yeah. And if you think about that with respect to, say first-time buyers, right? Do get out there in the marketplace after they've worked with an advisor to go and get a pre-approval. No first-time buyer is going to say, can I have an 80% pre-approval, please? I'd just like you to approve me to 80% of what I could borrow, please. They want it at ceiling. And most of the time, give or take, they'll execute the sale pretty close to that ceiling. So if the ceiling's rising, property prices should go a little bit with it. And, I think I'm fairly positive around where we're at. And I think it is a good time to look at your options, because if we think about the market, and economists, the Reserve Bank suggested that 2025, 3.8% would be now the economists are chipping in at somewhere between 5 and 7% expectation in property rises.
Yep.
So not a lot, but something. Okay. And there's a couple of reasons why it's not that high. One of them's migration. But the biggest influence in my opinion is we're carrying a lot of stock.
Yeah, heaps. A lot. It's noticeable. But there's a difference between stock and motivation. So if you've got 4,000 or 5,000 properties on the market in Auckland, some of them might literally just be sitting there with no motivation at all. You know what I mean? Like they can just sit there and, yeah. No, interesting stuff though.
Gives buyers choice, right? So there's that fear of missing out just isn't there. But I guess what I'm suggesting is that as that stock nibbles down a little bit by bit, is because we know the investors are active, right? They're back in the market 90% above where they were 12 months ago. That stock will start to diminish, and at some point, I think there's going to be some real activity. So for us at the moment, because we're at the coalface, right here, right now, leads coming in every day, people wanting to do some stuff. So right here, right now, what we're finding is our lead inquiries are up, but more noticeably, the time it takes that lead inquiry to get through to buying a property has shortened up considerably. Considerably.
And my point from last week was there's something like 65% of all loans in New Zealand are actually floating at the moment, and 70% of all new loans written start out as floating, and the people aren't necessarily fixing them very quickly because they see interest rates coming down again. So people are starting to take advantage very quickly of these lower interest rates and the better cash flow that comes from it. So I've just got my first statement through from BNZ from fixing last week. Next month, all of my mortgages under those loans will actually be a lot cheaper, and it's going to hit my bank account pretty quick, as opposed to, oh, I've got to wait another 6 months to go on to a floating rate to take advantage. You know what I mean? And I think there's a lot of, well, statistically, there is more than half the people in the country can take advantage straight away.
So you feel pretty good about that, right?
Yeah, and there's cash in my pocket. I can prove better servicing. I can go to my broker, and the test rates are a lot lower, from 9 down to 7%. Means I can use a lot more of the equity that I've got. And houses are cheap, and there's plenty of them on the market. What I do kind of struggle to see the bad side.
So what are you going to do?
Well,
Probably go out and buy one.
my GV, you got to remember, like, for those guys online, most of my portfolio is in Wellington. The house I'm physically sitting in now went down $810,000 when the GVs were adjusted a couple of weeks ago. My portfolio as a whole, my Wellington portfolio went down a little over $2.5 million when the GVs were hit. But I just don't care, because I'm not looking to sell anything. I'm looking to buy more stuff. And all I'm really interested in is the interest rate, because I want more cash flow. I'm ravenous for cash flow. I love the stuff. Yeah.
When you've got that cash flow, mate, and this is what's happening, you're going to do some other stuff, right?
You do what everyone else does. I'm going to buy some quality assets before everybody else jumps on that and start talking about it around the barbecue. And then
100%.
it's a cycle. I love it when people just don't get that. I got a question for you, though. Go. Which bank has the least restrictive servicing policy? How are they treating rental income? Still a haircut or plus rates, insurance?
Yeah, all the banks are haircutting. At its worst, Joe, and I'll get to your question. At its worst, what was happening was that they were giving rental properties a haircut, but then they were also asking us to itemize the expenses. So let's say you had a 25% haircut. Now that was supposed to take care of rates, insurance, repairs and maintenance, vacancies, right? That was the haircut. What the haircut was for. And when all this triple CFA stuff came in, it was the haircut. Oh no, sorry. Oh no, I should have slept. But yeah, but that it was the haircut, and in the servicing calculator, you would have to put in the rates and insurance specific to that property. So they were double dipping for a while. That in the main's now gone. I think the servicing environment is pretty even. I don't think there's any standout, except in certain client circumstances where some banks are better than others for individual circumstances. Right. So it really boils down to the personal situation. If you've got a fairly vanilla situation, you could throw them in, and the banks will be within cooey of each other, except for some outliers.
Yeah. Yeah. And I mean, my position on that, I suppose, is that if every bank in the country had $100, they all want $99.50 lent out at all times. And so they loosen the restrictions when they want to lend more money out, and they put a special rate out there, and they tighten up when they want to go the other way. So the market's the market, and it just acts the way that it acts. You know what I mean? I see that a lot all the time. What's happening with cash contributions at the moment? How hard can you push banks and stuff?
Yeah, look, it can. They're certainly there. The bigger player, ANZ, will give you $5,000. There's some really nice offers for first home buyers from some of the smaller players. SBS Bank, really good. Unity, one of the old building societies, really nice first home buyer package as well. So you would certainly expect these days the banks are going to package you up a good deal, Katie, and worth exploring your options.
Yeah,
worth exploring your options. And again, it also depends on if you qualify for a first home loan, KO first home loan. That makes a big difference to your pricing as well.
Yeah, absolutely. Excellent. Is anybody actually doing a lot of trading at the moment?
Seeing a bit.
Yeah.
And to see a bit.
It's not flavor of the month. It's been pretty slow, but it's certainly coming back, isn't it? I got a video post about it.
I think it's a perfect market for it.
Yeah.
Perfect market. Flat market's perfect market.
Yeah.
Slow increase, perfect market.
Predictable.
Yeah, it's reliable. So, people who are trading made made a lot of money when the market was going like that. They just have to buy something, right? So, it's if they were lazy, they'd still make money. The biggest issue that they had was making sure they didn't pay too much for something. And during a market like that, fear of missing out is through the roof. So actually getting your hands on some quality stock was difficult, very difficult. But in this sort of market, all you got to do is buy well.
Yeah.
And you get less money.
Not difficult. You just got to trust yourself. You got to trust those numbers.
Yeah. So look, I think traders will come back with bit by bit as they start to see that it's a market that they can rely on. If they do a good job on the deal, they will make the money.
Yep.
Okay. Because all you got to do is buy well, reno well, stay on the budget, flick it out the other side, probably turning them over fairly promptly. Now that there's a little bit of activity, because that would be the thing that would have put people off in the last sort of 6 months, maybe, is that the sales cycle was a little slow. So they would have money trapped in the deal for a little bit too long. But I think that will now shift with some shorter sales cycle. So,
yep. And also, like your average trade property, your average flip, you buy, renovate, sell is a 3 or a 4 bedroom with some land around it. So you're squarely staying away from 2-bedroom townhouses, which is oversupplied in all the main centres. You're talking, second or third home buyer territory for people who are having young kids and families and want to put the barbecue out the back. I think that's solidly where the market is at the moment.
Yeah, you got to stick to the basics. It's a really nice environment for doing quite nicely out of trading.
Yeah. So what do you reckon the crystal ball is? Do you agree with my ideas about where the OCR goes, going down 0.5 and then 2 at 0.25, something along those lines?
Well, OCR will hit 3. That's considered neutral. It may go under. We have the pleasure of Adrian. I've been with someone that Ben Adrian. So we had Jared Kerr, Kiwi Bank chief economist, meet with our team last week. Certainly for him, 3% a no-brainer, could go under that. His thoughts around that rate choice was he feels that potentially on that 2-year fixed, you could get sort of, to 4.59, 4.79. I'm not 100% sure about that, but again, that's, where his thinking was going. And certainly feeling that, the net migration dropping as it has sort of stalled things a little bit with respect to the property market. And with the migration piece, also noticing a real shift in the demographics now coming into the country, which would shift towards more condensed housing. So potentially for him, he's feeling that perhaps construction might take a bit of a lift later on in the year.
Would be nice. I mean, we could also open up immigration and start selling visas to New Zealand, Trump-esque, he seems to think that's $5 million for a green card. We can, we're a lot greener than him.
We might get a few Americans coming out just quietly.
I mean, if they're exiting America, they probably are sort of people, right?
Yeah, all the fast food joints will enjoy it. So I think, I think it's just she'll be a little steady as she goes. I'm positive about it, but I'm not overexcited about it. I just think it's going to be a really nice, reliable marketplace where investors who are good at what they do will do well.
Yeah.
I agree. It's like, I'm happy with that. I think, I think it is a good time to take stock. And I think that if, people on the call are either looking at their current lending position, wanting to review it, they should. It's a good time to do it. If they're looking to re-engage back in the market or take a first step into purchasing their first rental, it's a good time to look to do it, because most people are suggesting there's going to be some upside through the course of this year and next year. Yeah. Okay. So, yeah, I think she's a good time to have a little look at and take a start at least putting together what your strategy is, because we all know we're going to have to do something.
Yeah, and I mean, it's last week's webinar, we actually talked about my portfolio spreadsheet, which is, in essence, it's the very beginning of doing your statement of financial position, which is the first thing that a broker is going to want to look at. Do you have any money? Do you have any cash flow? And yeah, so later on tonight, I'll show you how you can get a free copy of that, because I think it actually is really important. Um, I agree with you. I think that it's always a good time to buy quality assets. I think that's what it comes down to. Yeah. So talk us through this. This is something that we've been on the sidelines gently working through. It's a capacity discussion tool.
Yeah, and I think it's not gospel.
Yeah.
It comes with a few disclaimers. We're working on it as a project to try and see if we can, provide your team with something that will shape up where capacity to borrow should sit.
Yeah.
It's a self-help tool.
Yeah. So you can put your own numbers in and you'll get a rough grey version idea of whether you are fundable. And then you take it to your broker team, who then take it to a credit team at a bank to get the actual gospel out of it. So what we're basically saying here is that we have a portfolio spreadsheet where you can list into the Excel spreadsheet all of the assets that you actually do currently own and figure out what your statement of financial position is. You can then transcribe some of those numbers to this spreadsheet, which will give you some sort of rough idea of whether going to a broker or a bank at the moment would be a good idea for you or not. And then we have a third spreadsheet, which is for each individual deal that you do to analyze cash flow and whether it's a great deal, net and gross yields, but also how much you can spend on the property. If you're going to sell it, how much you're going to sell it for, and therefore whether that's going to be profitable as well. So basically 3 spreadsheets to run the world, but like they're just helping the individual investor in the background get a really rough idea of where you currently sit, what you can do, and then what you can do with that, if that makes sense. This is a work in progress, obviously. We'll have it ready in the next week or so.
Yeah, it's good. It's a good tool.
Yeah, lovely. All right. So, so really, I think it comes down to who's ready to go and actually get stuck into this market. I'm certainly looking at improved cash flow, improved interest, how hard it's been to get Dave Windler on a webinar when he's actually awake, because him and his team are so flat out doing pre-approvals for other people. And obviously, me, I'm a little busy too, still writing my book. I'm actually going to Melbourne for a couple of days tomorrow and then back again, and then straight back into a webinar next week. And then end of the month, obviously, one of the biggest property events in the country, which is my roadmap for property success. Now, this is the Grand Millennium Hotel in the Grand Ballroom. We have a limited number of seats and people that we can put in there, and we had an absolutely massive intake at the last webinar. So we literally have 4 VIP seats left, and then a whole pile of doubles and bits and pieces. Now, the single tickets are cheap. The double tickets are actually really well discounted, because we want you to come along with your wife, business partner, property investing partner, and get stuck into it. But also because Dave Windler comes along to this thing with his son. I go along to this thing with my son. Steve Stark, my head coach, comes along with his son quite often. So does Grant Hoey, who runs our management team. We're all at an age and a position in our lives now where we're actually bringing our kids in and getting them to have a really good look at the stuff that we do for a living and getting their heads around it and trying to create intergenerational wealth. So we have made the double tickets really super economical for this event. And we've got some really cool and really new stuff in this, because I keep saying this every 6 months, and I mean it every 6 months. It's a different market than it was yesterday. My God, things are changing quickly. And I believe that we will have a lot more big changes based on official cash rate and the result of that with cash flow flushing through the market in the next few months as well. So how can you win in this market? We're actually going to cover all of that, because it's different now than it was a year ago. With interest rates and the amount of property on the market, we're going to be telling you about new and fresh strategies and showing you stuff that we are doing currently in the market that's new and fresh as well. Which brings us to our investor panel, which is where we bring up to 10, hopefully as many as we can, property investors that are doing the deals that you want to do right now up onto the stage, and we ask them questions about the deals. They show their deals, their live deals, the things they're actually doing in the marketplace now, and you get to ask them questions as well. Obviously, we've got our experts coming up, which is Dave Windler, who's you've obviously spoken to tonight, Matthew Gilligan on tax entities and structures, and we've also got Mark Trafford on renovations, who's in the webinar with me next week. Also, we actively, massively encourage people to network within this event as well. And to do that, we're actually buying you guys lunch if you come along too, because we want you to sit down at the table, have a chat to other people, ask them what they're doing. People pick up joint venture partners, they pick up ideas and tips, and it's a really, really, really sad dating service, basically. Jokes. We also have a very, very good, inspiring international guest speaker this year. We haven't done the guest speaker thing for many, many years for an international guest speaker, and we've got somebody really, really good. I haven't really spoken about this because it's taken a long time to get this one organized and sorted out. We're very lucky to have this person, and I will be launching it either next week on the webinar or on the Facebook page during the week as well. This is actually going to be very, very cool. I believe that the couple of hundred people that have already bought tickets to this event will make sure they use their tickets, turn up, be very, very interested in this. And I believe that anybody online tonight who's really interested in getting stuck into this will be blown away by this person and this presentation as well. So we've got a deal for you, obviously, for jumping on the webinar tonight. It's a few hundred people online. All you need to do is go to stevegoodey.com/webinar promo. And what we're going to do is we're going to give you a 25% off on any of the tickets you want for the first 10 tickets. Remember, we've got 4 VIP tickets left. Those are the front tables. They tend to win all of the prizes. They got chocolates on their tables. They have a bit of a chat to me before the event. They get all the good stuff. Then all you got to do is step 2, make sure that this event's in your calendar. Come along. Step 3, we'll have papers and pens and networking and all sorts of things. And we will also, as a bonus tonight, give you a copy of my portfolio spreadsheet so you can see how much equity is sitting in your portfolio at the moment. Even if it's just one house, the one you're living in, totally fine. We can chuck it in there and it will analyze it all for you, figure out your cash flow on that, what it's costing you, all that type of thing. Supremely useful piece of tech. We'll give you the capacity discussion tool as soon as Dave and his team has finished designing it, making it happen. No pressure. And we will give you our project calculator, which Steve Stark, my very, very favorite spreadsheet creator and train spotter with the details and the numbers, who has designed and been working on for years and years and years. So that's all you need to do. stevegoodey.com/webinar promo. Grab your ticket. So while I've still got Dave on the line for a couple of minutes, and while you guys are grabbing your tickets to that, we're going to try and answer any of the questions you've got, even if it's questions about grabbing tickets and stuff. Remember, too, that we've got 2 more webinars to go in this series. Next Wednesday, the Wednesday after. The very next webinar is myself and the good-looking young Mr. Mark Trafford, who always brings the goods to these webinars with actually really, really cool projects that he's just finished or is up to his eyeballs in right now, or is really, really busy working on. He's renovated more houses than most people have had hot dinners. Great source of knowledge, information. He'll also be at the event as well. So I'm going to leave it on this page so you can go to stevegoodey.com/webinar promo to get 25% off for the first 10 tickets sold. Remember, 4 VIPs left. And in the meantime, let's jump back into some silly comments. Let's see what Mr. Orr's got going on. This is an interesting one. Thought on an OPS AI tool that Ed and Andrew have been talking about last night. Didn't see it. I've seen them promoting it. Looks kind of cool. Might be worth a bit of a tickle. We're a very, very different company to OPS Partners. But I like those guys quite a lot. We do a lot of stuff together. I've been on their podcast 3 times now, I think. And I do love their work. I love what they do. I haven't played with it yet, though. I'd love to hear somebody else's feedback on that. It looks pretty cool. Next question from Chris. Any of the main banks opening up to traders, especially ones with solid numbers, or still relegated to second tier?
I'd like to be able to give you some good news, Chris, but nah. So the thing is, when banks are looking at traders and looking to use income from trading, property trading, to therefore service a 30-year mortgage, they just view it as speculative. Okay, so a property trader can do 2 or 3 deals in 1 year. There's no kind of guarantee they'll do 2 or 3 years deals in the next year. So there are some tricks around massaging around that, so we can get traders access to high quality funding. It's one of those ones you're gonna have to touch base with him, mate.
Yeah, but the upside there is that the second tier lending used to be incredibly expensive, and now it's not as expensive
now. Yeah, so it's very much in line with the OCR. So as the OCR keeps coming down, and therefore floating rate comes down, then a lot of the second tier funders who operate out of warehouse funding lines given to them by the banks, their cost of funding is coming down in line with the OCR, and some of the second tier rates just will drop the next day, just like the banks drop floating rate. Yeah.
But the gift here too is that these second tier funders aren't using the same rules, terms, and conditions, and you're not using the money for as long. So, you're not holding the debt for 8 or 9 or 10 years. You're holding it for 5 or 6 months, maybe. But it's just easy to deal with. There's less questions.
Yeah, 100%.
Love that. Thanks, Adrian. Love your work. Go to the Batch and Taupo. Take some time off. Take the rest of your life off. Appreciate it. I appreciate your humor as well. Excellent. Ooh. Oh, any property managers worth 7-8% if you're doing your first time rental property, or should you go at it yourself first? Oh, property management. Oh, don't even. I'll tell you some scary stories. I caught up with Shardy, Let's Rent in Auckland last week, and she's always a good one for some horror stories. She's an incredibly good property manager. I hate the idea of managing my own properties. I think it's a beating to nothing. I didn't get into property to be a property manager. I'm sorry. But hey, you do you. Yeah. Vladimir would like to know if we could lend him some money for a large-scale project. You guys are not as funny as you think you are, honestly. You're way funnier. That's gold. Excellent. Obviously, the promo codes are, there's people jumping on there and grabbing their tickets and bits and pieces now. Excellent.
So, question around Australian income list, I saw. I can't find it, but it was around what sort of percentage of income from Australian income or banks she's in these days. In the main, 90%. They're much better with Aussie income than they are in other areas. So, just in wider context, anytime that we've got overseas income, the banks will apply a haircut for foreign currency fluctuation. Okay.
Yeah.
But the best treated currency is the Australian income. So 90%, 10% haircut. Pretty good.
Yeah. So all the FIFO workers just jumped up and down and went, let's go, That's great. Or Steve, see if we can get hands on those Excels, repeat webinarian. Is that a word? We'll claim it. Have your tickets for the big event, and you're not missing anything. We're just finishing writing them. You will get them. Turn up to the event. All good. Love your work. There's been a lot of fun and games with foreign money coming into the country. When you talked about the evil triple C thing, one of the things they had at the same time as that was liquidity issues with counterfeit money and, just weird Reserve Bank crap going on. And so much of that stuff is cleaned up now and it's just gone. Banks just want to lend money. It's people who've been paying P&I for years and years and years without actually re-lending the money and lending it back out again. So it feels like the banks are actually pretty stuffed full of cash right at the moment.
The appetite's there.
Yeah, absolutely. Katie asks, how tight is the Wellington rental market? I don't know, a few months ago, there was a news article about too many rentals and landlords having to drop weekly or offer incentives. It's still pretty much that way. Really, the problem post-COVID in Wellington has been that Victoria University hasn't really gone back to its old numbers of students. So they haven't taken out that whole bottom of the market. I've just re-tenanted one of my properties in Lower Hutt, and I had to drop $100 a week to get it re-tenanted, but I did. And of all the boarding houses that I run at the moment, I think I've got 3 rooms empty, which actually isn't too bad across a large portfolio. So it's not brilliant, but it's just not as brilliant as it was previously. As always, go to Market Rent, look up and look at the Tenancy Tribunal website and look at the bonds received and lodged and see where those rents are sitting for bonds actually physically received, because, that's a very, very up-to-date assimilation of exactly where those numbers are at. That's a good question for you.
Yeah, it's a read the whole stuff, but yeah.
What do you think of that?
Yeah, look, I think there's lots of different ways that you can rejig a servicing calc. And if you're an existing investor with existing loans, generally speaking, then the greatest improvement to serviceability will take place by restructuring debt that you already have.
Yeah.
So Yeah. So if you've been, let's say you buy a property with a 30-year loan term and you've bought it 10 years ago and you haven't changed banks and you've had 2 lots of 5 years of interest only, lucky you, that loan's now it's got 20 years left to go, and your serviceability on that loan is tested over the 20 years, the remaining term of the loan, over the 7.25 or 7.3 percent test rate. So quite often when we're dealing with new clients who are existing investors, the first thing we're looking to understand is what the loan terms, because that can make a big difference in serviceability, that one.
Yeah, absolutely. And it's all getting better, you know.
Oh yeah, 100%. Getting better all the time.
You know, do you see changes, issues getting insurance for boarding houses becoming commercial? Yeah. Pain in the bum. It's worth it because boarding houses cash flow like a mad thing, but it's near on impossible to get insurance for them. It's just so hard at the moment. I could sugarcoat it, but I'd be lying to you. Very, very difficult. I'm trying hard not to review any of my old insurances at the moment, simply because they're going up 40%, and if you complain, they just won't insure you at all. Madness. Have a go at that one. What sort of haircut would banks use for commission?
Varies. It's one of those areas of credit policy that varies between providers quite considerably. Depends on if you're totally commission or you're a base plus commission. Obviously, if you're in real estate earning commission, you've then also got expenses and you'll produce, financial accounts. So that is an area that can vary between, 50 and 80% quite easily. And so it's one of those areas of credit policy where the difference between banks is quite considerable. How long you've been doing it for is a big one, and what industry?
Yep. This one's an interesting one. Thanks for the answer on second tier. Keen to avoid the finance fees they add up if you're doing a few a year. Yeah, look, I'm sorry about that, but that's Dave's commission. These guys got to work for a living,
We do try and make ourselves redundant, with traders who are doing regular trading activity. There are a few things that we do to help you avoid those fees.
Absolutely.
Outside of working for free.
But also, like second tier lenders like that, you're lending for a number of months, not for a lifetime or until it's paid off. So, the bank's got to make some money somewhere, and the broker's got to be able to get a comm out of it for doing all the work. And trust me, these guys work, man. Yeah, no, there's going to be a cost there somewhere. There's not much else you can do about it. All right. Well, I'm watching the ticket numbers tick in quite nicely. So I'm going to leave that screen up for those people that want to grab that deal. Remember, it's stevegoodey.com /webinar promo, 25% off. And there's not 4 VOPs left, but if you're lucky, you might want to grab one of the last few bits and pieces. I'm going to thank you so much, Dave, for being here tonight. We're an hour and answering everybody's questions. We had nearly 300 people online, as predicted earlier. In the end, so it was really great. Always appreciate your fresh insights. There's a few people that have mentioned that on the side there, and yeah, great content, much appreciated, and really look forward to seeing you at the end of the month at the event.
I'm really looking forward to it too.
Awesome. Thanks so much, Dave.
Cheers.
All right, thanks everybody. As I said, I'll be online for a little bit longer to answer some questions back and forward with people, and grab those last tickets. If you have any trouble getting your tickets at all, message me directly on on Messenger through Facebook. I answer all of those questions. If there's any issues or hiccups there whatsoever, just get in touch and give us a yell. Other than that, thanks so much for coming along tonight. I'll leave the screen up so you can see it for a while, and grab those last tickets, and we'll see you next week for the webinar on renovations. All right, thanks everybody. Bye.